Derivatives are financial instruments whose value is derived from the value of an underlying asset, index, rate, or other financial instrument. The underlying asset could be stocks, bonds, commodities, currencies, interest rates, or market indices. The most common types of derivatives include futures contracts, options, swaps, and forwards. Here's a brief explanation of some key types of derivatives. Futures contracts. These are agreements to buy or sell an asset at a predetermined future date and price. Futures contracts are standardized and traded on organized exchanges. Options. Options provide the buyer with the right, but not the obligation, to buy, call option, or sell, put option, an underlying asset at a specified price within a specified time period. Swaps. Swaps involve the exchange of cash flows or other financial instruments between two parties over a specific time period. Common types include interest rate swaps and currency swaps. Forwards. Forwards are similar to futures contracts but are traded over the counter, OTC, and are customizable to the specific needs of the parties involved. How derivatives work. Derivatives enable investors and traders to hedge risks, speculate on price movements, and manage exposure to various financial markets. Here's a brief overview of how they work. Hedging. Investors use derivatives to protect themselves against potential losses in the value of their investments. For example, a farmer might use futures contracts to hedge against the risk of a decline in the price of crops. Speculation. Traders use derivatives to speculate on the future price movements of underlying assets. For instance, an investor might buy a call option on a stock if they believe its price will rise. Leverage. Derivatives allow investors to control a large position with a relatively small amount of capital. This is known as leverage. While leverage can amplify gains, it also magnifies losses. Price discovery. Derivative markets can contribute to the price discovery process by reflecting the collective expectations and opinions of market participants regarding the future value of underlying assets. However, it's important to note that trading derivatives involves risks, and inexperienced investors can incur significant losses. Due to their complexity and potential for risk, derivatives should be approached with caution, and individuals should have a good understanding of the instruments and markets before engaging in derivative transactions.